Climate change clearly sets out financial stability issues. As I say it today, it seems obvious, but it was not the case a few years ago. When we discussed it with our colleagues from central banks, there was always a doubt. Should central banks get involved in climate risk issues? Weren't they issues for the Ministry of the Economy or Finance or the Environment? We first tried to measure climate risk in terms of financial stability. If you develop a deeper analytical work, you realize that the impact could be major. As you know, there are two types of climate risks in the broad sense. There are physical risks, which are extreme risks related to the increased frequency and magnitude of climatic events. Typically, hurricanes, floods, massive droughts leading to immediate and heavy losses, but can also have macroeconomic effects. You may remember the very strong drought that caused the Rhine level to drop sharply. After that, it became harder and more expensive to transport goods along the Rhine, and there was an impact on the price of certain raw materials. For a long time, we were told that physical risk was covered by insurers anyway, so the financial impact was not that important. It is not exactly true. First, we realized that all assets are not covered by insurers. We have measured what we call the protection gap, i.e. the gap between the value of an asset and its insurance value. And we realized that it is very significant, especially in emerging countries. For instance, it is estimated that in Africa, 90% of assets are not covered by insurance. This means that when a physical risk materializes, the destroyed assets are automatically financial losses. No insurers cover the cost. And in developed countries, insurers are no philanthropists either. When a loss occurs, either insurance premiums increase or insurers cover fewer assets. So we realized that the potential amounts at stake are extremely high, and there is another type of risk called transition risk. What does this really mean? If we consider that our economies are going to change, our industries will change to match the Paris Agreement rules. There will have to be massive reallocation of capital and massive losses in value in certain industries. It is estimated that investors who bought shares in some companies, some industries, who bought corporate debt in some industries, may lose a large value of their portfolio. This is due to transition, and it is called transition risk. You might think, it's exactly what we want, to transition from point A to point B. Yes, we do, but we want an orderly transition, a methodical step-by-step transition. We want to avoid a disorderly change, where nothing happens for a while and suddenly there's a panic among investors who see the risk and a major collapse of asset price. This is precisely what we are trying to avoid. These physical and transition risks are complicated for us central banks and supervisors to comprehend, and they are quite different from other risks. Why? First, because climate risks in the broad sense are nonlinear risks. They are tipping points, and you can't just draw a straight line and follow it. You think, with projections, I'll have an idea of my risks. It doesn't work like that. We also realized that our macroeconomic models were quite useless to help us measure the risks because we are not in general equilibrium models. We are in disequilibrium models, nonlinear ones. And today, the models we use in our anticipations do not work. This means that we central banks and supervisors must find new models and methods to capture climate risk and measure the financial industry's exposure to these risks. Summarily, it is estimated that there are two ways to try to measure climate risk. The first one is called disclosure, transparency, publication. i.e., asking financial institutions like banks, insurances, investment funds to publish their climate risk exposure at a given moment, and that of a certain number of industries we consider as risky. That is one of the initiatives that the TCFD encourages, but I will get back to that. The interest of this approach is that it gives an idea of the climate risk faced by a bank, an insurance, or a fund at a given point. But the limitation is that it doesn't give you any indication of what will happen over the next few years or decades. It is extremely static, backward-looking even, because this picture gives you an indication of the investment strategies implemented in the previous years. But that's not what you want. You want to project and try to measure the risk over several years. So, in addition to this approach, we have developed another type of tool, scenarios. The scenario analysis is quite complicated too, and quite new, but it's promising. In the scenario analysis, we picture different states in the world and trajectories that the international economic system could follow to comply with the Paris Agreement. So, at the NGFS, I'll get back to it, we have defined about 8 different scenarios. And on the basis of these scenarios, we project exposures and try to see what happens. It's a difficult exercise because it requires measuring exposures, projecting them. We work on assumptions. We are not sure of anything. It's not a traditional stress test as we supervisors use them, where we project on a 1 to 3 years horizon. We look at restricted and new portfolios. So, it's different, and some central banks have already done scenario analyses. The Banque de France and the French Prudential Supervision and Resolution Authority did an exercise this year. The Bank of England has one scheduled for next fall, and the ECB as well. These exercises are about learning by doing. They complement the publication approach. You publish, you have a picture of a certain given point, and you project. You have an indication for the next 5, 10, 15, 20 years. And on this basis, you get indications about financial actors' exposure and the way they consider reallocating their portfolio of financial assets. The risks that climate change poses in terms of financial stability are global, and it requires a global response. In 2015, the G20 created a study group, which truly helped move forward on how to measure risk, but also on the financing component, how to raise capital. In 2017, this political coming from the G20 gradually vanished for political reasons, simply because the new U.S. administration diminished its support on the subject. So we at the Banque de France wondered how to develop contacts with our peers. We had methodological questions on how to measure things, how to develop scenarios, and we had no answer. And we thought, instead of working bilaterally, why don't we create our own forum? So we resumed our mission and started contacting one another. And it became a coalition of 8 members at first, and now over 90. It became the NGFS, the Network for Greening the Financial System. What is the NGFS? It's a group, a coalition, a club for central banks who want to work together, who want to share and learn all together. I often use the picnic metaphor. At a picnic, we each bring something and we all share. The NGFS is like a giant picnic. Everyone brought their own perspective, their methodology, what they had learned, and we shared. And it quickly helped everyone grow much more than we would have if we had stayed in our own corners and waited for things to happen. In addition to the NGFS, other coalitions came together. The most famous one is the TCFD, Task Force on Climate-Related Financial Disclosures, a specific task force created by the FSB and composed of private sector members. They represent the financial industry, but also the non-financial industry, and they voluntarily lay down rules and publish their climate risk exposure. The TCFD was very successful, and today many financial and non-financial actors monitor and publish their risk exposure according to the TCFD. but we begin to see the limits of the exercise. Why? Because a voluntary approach means that as a company, you may not publish everything. You may not publish things that embarrass you, that could be significant to you. The question now is, should we go beyond the voluntary approach, beyond the TCFD? Should we start talking and gradually evolving towards required mandatory approaches? What I can say about these past few years is that coalitions, the NGFS or the TCFD, have catalyzed all the energies and helped everyone make progress. This was a very broad presentation. I wanted to give you a glimpse of how the central bank's community has structured itself on the international level to measure and prevent this climate risk. Now I will give the floor to Laurent Clerc, who will present the specific way in which the French Banking and Insurance Supervisor, the ACPR, has led its stress test. He will also give you the main conclusions of the test, which is a world first.